know you're waiting to call in, and we'll get to your calls in the next segment, folks. In the meantime, let's take a look at David's past picks, and we'll start with Hess Corp. This one down 15%. We had a huge shakedown in the market yesterday. Today, a little bit of I don't want to call it a comeback, but markets are certainly a little bit higher. Explain this one. Do you still have it?
Okay, so to be clear, right, we're looking back a year, right? Yeah. And between a year ago and today, you had a 20% collapse in the market. Mm-hmm. And it was a bull market correction that completed and moved on. But we use stop losses on everything we own. And I want to be clear, you know, we are not buyers and then hold through thick and thin. If stuff starts to pull back and pulls back and breaks long-term trend, we make an exit. So we came out of a huge percentage of our positions in the fall of last year in that sell-off. We own Hess again. But we have very little energy because, frankly, the energy theme is not one that is working in the market right now. Hess is in an interesting situation because they got a giant global find. But we came out of it in the fall of last year. We wound up back in the name sort of in the spring of this year. It's a stock that I would buy if I wanted energy exposure, but I wouldn't put the energy theme in my sort of top 5 themes right now. It continues to be very, very weak, and it continues to be sort of under pressure.
All right, let's get to your second pick here. Past pick, JP Morgan, arguably the best bank on Wall Street. Here you're theoretically down about 5% from September of last year. I would assume you still have this.
Yeah, we own JP Morgan. It is you know, really the best bank in the U.S. They got a great capital markets business. They've got a very good dividend growth, sort of 15% dividend growth off a 3% yield, pretty attractive. Stocks pulled back a little bit, fully within trend, so I'd buy the stock here.
Okay, and let's round this out. We promised our viewers we would get to Boeing. This was your past pick. Since you presumably exited, I would say, back in March, the stock's down about another 11-12%, but from September off about 8%. Are you happy to be out of this stock?
So, as I mentioned, we really like the defense sector.
Yeah.
And this will be a stock to own again.
When?
Right? You got to wait and let the market tell you. Okay, so as I mentioned, we use stop losses. When the market broke, when the stock broke after the FAA shut it down, we came out of it at $377 a share. The reality is there are 2 major producers of commercial jets, and Airbus cannot supply the market. So this is a situation that will get fixed. Boeing has an excellent record. I'll wait and see the market start to turn technically before we'd put the position back on. But for those that own it at these levels, it's probably one that you want to hold on to.
I'm not quite sure how to articulate this. We've got about a minute to play with here. But when I look at your picks from September of 2018, there is a bit of a realization here that as much as we get caught up in the short-term trades where we saw that huge run-up in tech from this December sell-off through May, June, and then we started seeing some turbulence again, this is a pretty good reminder that really from September 2018 to today, we're not really that better off, David. It does speak to maybe a bigger concern about the markets, or does it not?
Yeah, no, it doesn't. I'll tell you why. Look, the way the market acts in a bull market is you rally 18, 24, 36 months, and then you consolidate. And corrections come in 2 ways. They come in time, and they come in price. Okay, so the market had a high in February of 2018. It spent really about 10 months chopping sideways. Ultimately, it was a 20% decline. If you went back to 1950 in bull markets and took every one of the declines of greater than 12%, on average, they were about 9 months. On average, it was about 19%. And when you broke out to new highs, on average, before the next major correction, it was 30.1 months, which would put us out to 2022.
Okay.
And on average, the market rallied 89.9% before you got the next major correction. So market consolidated all through 2018, much like it did through 2014-15. You broke out to new highs. Yes, you're pulling back into that range, but it's likely it likely will be a very short-term correction, and you're likely to see a follow-through over the next 18 to 24 months.
All right, let's see how all that continues to pan out. Like you said, there certainly is a lot of noise in the short term that is occupying investors' minds. Let's take another break here. We're coming back with David Burrows. We're on North American Large Caps.